De oportunidades de inversión, de en qué momento nos encontramos, sobre todo sabiendo que estamos en un entorno de máximos históricos con expectativas de bajadas de tipos de interés. ¿Dónde hay que invertir ahora? Se lo vamos a preguntar a Alliancebernstein, a Henry Smith, Investment Strategist, Multi-Asset Solutions at Alliancebernstein. Henry, good afternoon. Thank you so much for being in Noticias Televisión.
Thanks for having me.
Henry, what are your reflections on the markets in 2023?
Sure. So I guess an interesting viewpoint, and one that I think is important given we kind of expect this trend to continue this year, was that 2023 was very much a year of normalization following pandemic era extremes. And by that I mean, since the onset of the pandemic in early 2020, we've seen significant volatility in key macroeconomic variables around their longer-term averages. And 2023 began to see a move back towards what we'd sort of call normal type conditions, in that I guess one of the key variables was economic growth. If we think back a few years, lockdowns in the early days of the pandemic strangled economic growth, and we subsequently saw a reversal in 2021 with booming activity as vaccines were rolled out. We then had 2022 where growth started to slow again as geopolitics came into play, rapid increases in interest rates and higher inflation really started to take their toll. But we think then to 2023 last year, and we saw economic growth start to normalize and to broaden in line with pre-pandemic trend, supported by positive economic surprises and in many places around the world, pretty resilient consumers. The other two important variables are inflation and interest rates. I'll start with inflation. And here, I think we all know and certainly feel it, but following the pandemic, inflation reached multi-year highs in 2022. And while it was still high in 2023, we started to see in prices slowing in terms of their increase in inflation, returning towards pre-pandemic levels. In terms of targets. And I guess the final one then is interest rates. So we started to see rapid increases in interest rates in 2022 to try and tackle inflation. In 2023, while rates remained high, that sort of level of increase that we'd seen in the previous year was not repeated. And 2023 was more muted in terms of tightening of monetary policy. I'll sort of add to that and just say, this normalization theme was a bit broader than just the macroeconomy. If we think about capital markets, many of the biggest laggards of 2022, such as growth equities, quality equities, real estate, and various forms of fixed income, actually had pretty solid years in 2023 and in many ways bounced back. And I'd sort of end, I guess, that sort of question by sort of saying that this reflection of normalization maybe isn't quite perfect, because I think there are some key areas of major structural divergence that still remain. So if we think about some key emerging market regions and their valuations compared to before the pandemic, areas like China and Russia, these equity markets are considerably lower than they were pre-pandemic. On the other hand, we've got things like oil, which have prices considerably higher. And we've also seen a handful of US mega-cap stocks, which are often referred to as the Magnificent Seven, dominate equity returns over the year.
We've already spoken about the past, but what is ahead of us? What is Alliancebernstein's macroeconomic outlook now?
Sure. So I guess inflation continues to dominate the picture. So it's very much in the minds of investors and policymakers. Eurozone headline inflation is now around 3% and sort of broadly similar levels in the United States. So inflation now is seen as being on a better path than it was. And it has continued to sort of begin to fall towards target levels, albeit with some quite slow progress. But central bankers are starting to become increasingly confident about that trajectory from here, which means we believe that interest rate cuts are now on the horizon. And when these interest rates hit, they come at a time when economic growth is positive albeit, pretty unspectacular. So we're really looking at pretty low levels of economic growth, but importantly, positive levels of economic growth from here. And that's really starting from a strong base of 2023, where growth was very resilient. From here, we expect a number of the tailwinds that supported last year's growth to sort of fade. In particular, we see a cooling labour market, a decline in business investment, and more specific to the United States, we see the pivot of fiscal policy turning back to a more sort of contractionary stance. That said, I'd sort of say again, there are some pretty big regional differences here. So the US is still set to be the high achiever for 2024. When we look at the Eurozone and the UK, growth here slowed at the end of last year as the peak impact of monetary policy started to take its toll. Though from here we can sort of expect a modest rebound as real income starts to improve, as inflation normalizes and looser monetary policy starts to spur economic activity.
What are the key opportunities that you're seeing now in the market?
Sure. So given the outlook that points to positive, if low, growth, normalizing inflation and sort of easing monetary policy, equity markets intuitively, given that backdrop, offer pretty attractive forward return potential. But to try and dimension that a little bit more, if we looked at history as a guide, if we consider all previous US rate hikes going back to 1974, and how US markets performed in the following 12 months from those interest rate peaks, two sort of broad camps start to emerge. You've got the camp where that period was associated with a recession, and there was also those where that period was not associated with a recession. And if we look at returns on average during those two camps, if there is a recession following a rate peak, markets tend to return about -2% on average. But on the other hand, and there's a really big difference here, if there is not a recession, equity markets on average saw a return of 24%. So when we think about where we are today, in terms of the last US rate hike being at the end of July last year, US stocks have appreciated about 8% through to today. So if the economic growth trajectory plays out as we broadly expect, and that is we avoid any form of meaningful recession and we see low but positive growth, that sort of highlights that there could be some potential upside for equities to continue from here. Beyond equities, I think the other tough decision for investors is that bonds are also looking very attractive. So at the most simplistic level, bond yields, which are essentially a measure of bond income relative to their price, are at some of the highest levels we've seen for a decade. And even lower risk fixed income, things like US Treasuries, offer a yield of about 4.2%. And that really sets them up for attractive return potential going forward, provided that interest rate expectations do not move materially higher from here. And so given that both equities and bonds have attractive features associated with them, attractive potential forward return potential, we really do advocate a multi-asset approach that instead of just selecting one asset class, is able to balance the potential return opportunity of many different asset classes. And then I guess more broadly, more focused in terms of potential opportunities for markets in the year ahead. I guess one potential opportunity is investment in the United States. So as I've kind of touched on already, growth in the US has been much more robust than it has been in other markets. And in many ways, we expect that to continue. And from a market perspective, the US has materially outperformed over the last decade or so. And while that sort of naturally creates this question of whether that can be sustained, when we actually look into some of the drivers of outperformance of US markets, we kind of see that a lot of that can be explained by very attractive levels of earnings growth that has outstripped what's been on offer in other developed markets. The technology sector in particular is, I think, a jewel for the region, but there is strong earnings outside of technology. And so I guess what I'm really getting at here, I think, is investors really need to assess how effective their allocation and the size of their allocation to the United States is, given the robust corporate earnings on offer within the region. And I guess the final opportunity that I would sort of highlight, and something that we see within reflected within our portfolios, is that this broader slowdown of the economic environment that we're going into requires us to look for areas of very attractive growth, and therefore somewhere where we can access attractive levels of return potential for our clients. And one of the ways to do this is through a growth-oriented sort of thematic investment approach, such as those that look at sustainable investments, considering things maybe in the areas of climate, health, and empowerment. And when we think about these different broad themes, that gives you exposure to sectors such as electric vehicles or wind power generation, which have very high levels of growth rates. In fact, I think it's electric vehicles are expected to grow at an annualized 24% going forward. And it's not really just climate. You've also got areas of empowerment around technology, thinking of things like artificial intelligence, and that market growth is expected to be around 19%. So we believe that these sectors and their associated growth rates offer really attractive areas of investment for investors, given that we're going into an environment where GDP growth could be 2% in 2024.
Henry, on the other side of the equation, what are the key risks that investors should be watching closely?
Absolutely. So with interest rate cuts on the horizon, I think the most obvious risk at this stage is how differently events might unfold compared to the market's current expectations. So financial markets are pricing in at the moment faster cuts than central banks have indicated that they are ready for. And while there's sort of been some repricing so far this year, there is still some form of mismatch. And this mismatch won't really change the medium-term path for policy, but what it will do is likely cause some significant market volatility this year as traders revise their expectations and try to time pricing of interest rate cuts. The other big risk is geopolitics. So 2024 is a very big year for politics. In fact, it's the biggest election year in history, with around 40 different countries representing around 41% of the world's population expected to go to the polls. And the election in the US will probably be receiving particular attention from markets this year. And when we think about our experience around election years, our research suggests that elections do not typically affect medium-term performance. That said, elections do drive heightened volatility in the near term. And so we would caution investors to consider this risk carefully, as well as the risk of trying to time any election outcomes within markets.
Given your outlook, Henry, how is Alliancebernstein's positioning its multi-asset portfolio?
Sure. So given the sort of opportunities and risks I've kind of talked about, and those that we see going into this new year, our asset allocation within our multi-asset portfolios favours a few different approaches. The first of which is exposure to attractive growth themes. So kind of as I've touched on, these are investments in things like sustainable investment themes that can help align portfolios with strong levels of growth in what we expect to be a pretty low growth environment. The sort of second thing that we favour is unconstrained approaches that provide access to regions that we deem attractive. So I've sort of talked about how the US has pretty attractive corporate growth potential, pretty attractive corporate earnings. And so really thinking about, are there allocations that I can influence the US that are unconstrained, able to dynamically move between the various different investment opportunities within that region? And then the sort of final opportunity I'd highlight is a favour towards quality and low volatility approaches within our portfolio. So really these allocations are designed to help navigate those greater geopolitical risks that we see on the horizon, and some of that uncertainty that we see around the path of future interest rate cuts.
Smith, investment strategist and multi-asset solutions in Alliancebernstein. Thank you so much for your time here in Negocios Televisión.
Thanks for having me.
Bueno, pues hablando de mercados, ya saben que a esta hora cierra el mercado europeo, así que vamos a repasar cómo ha sido ese